Expectations are running high as the Narendra Modi-led government is going to table its last full budget in a few weeks from now. Suggestions from the industry and various other quarters are pouring in. But unlike that of the centre, states' financial position hardly attracts attention, although they have not been doing great. The tax revenue of some state governments have been declining, making them more dependent on the central government. So, is it time for states to levy their own income tax? First, a bit of background. In June this year, against the backdrop of the financial crisis in Sri Lanka, India's central bank had come out with a report highlighting the fiscal vulnerability of some states. The Reserve Bank of India (RBI) flagged high debt levels of 10 states. It said that of all the tax collected by the state governments across the country, these 10 debt-laden states account for more than 50% of all tax collection. And this majority share in state tax collection by the 10 states has made public debt a fiscal risk for the country. And of these 10 states, the RBI identified Bihar, Kerala, Punjab, Rajasthan, and West Bengal as highly stressed, saying that they could face a crisis if they fail to curb non-merit expenditure. The debt growth in these 5 states has outpaced their gross state domestic product growth. The pandemic also exacerbated the problem. In November 2022, Business Standard reported that the gross fiscal deficit of states had grown to a whopping 79% after lockdown. The RBI report also said that these states spend 80 to 90% of the revenue on operational expenditure to keep the government running. It also included expenses that have short-term impact and do not lead to creation of any tangible asset. It leaves little room for capital expenditure. States earn through tax collection, non-tax collection, and from central transfers, which includes both tax sharing by the central governments and grants. Tax revenue may include excise duties, property and land tax, and entertainment tax. Non-tax revenue, on the other hand, includes capital appreciation and dividend from state PSUs. A big chunk of states' revenues come from central government's devolution in form of state GST, other taxes and grants, but the tax revenue of some of the state governments has been declining over the years, which has made them more dependent on the central government. So, is it a cause of worry?
It's a puzzle that especially when there is an increase in the devolution, increasing from 32 to 42%, and coinciding with the deterioration of the fiscal conditions and among the states. Why the states, when they're getting more untied grant, why should their fiscal situation deteriorate? So I think we need to get the answers on that. So what's happening right now is many states are actually getting into revenue expenditures which are not sustainable, right? And it is not really helping to create capital assets. Rather, it is more of a transfer, which is not going to create any kind of a output. I think that is the crux of the story right now.
States have long been demanding a higher share of tax collection by the centre. According to the latest Finance Commission recommendation, states should receive at least 41% of all tax collection by the central government. But in the last 5 years, devolutions by the centre have ranged between 32 to 37%. It was only in fiscal year 2020 when the share touched 41%. Of all the tax collected by the central government, cess collection is exempt from sharing. The Article 271 of our Constitution specifies this. Interestingly, since 2014 when Narendra Modi came to power, the share of cess in tax collection has gone up from less than 6% to about 20%. This means that the central government is not bound to share 20% of its revenue collection with states.
All cesses and surcharges are non-shareable. And what has happened over the last several years is that the center has not raised the base tax rates. In fact, it has lowered the base tax rates in some cases, but has raised the cesses and the surcharges. So if you like, for instance, an income tax, you have all kinds of surcharges that are put on depending upon your income level. Those are non-shareable. And those get in a huge amount of money, right? So what the center is doing is essentially taking advantage of a constitutional loophole to reduce the state share and keep more for itself.
Budget data shows that the gap between net transfers and tax transfer from the center to the states has widened over the years. In 2021 to 22, tax transfer from the center amounted to 8.82 trillion rupees, while net transfer for the same period was almost double at 17.4 trillion rupees. In the first year of the Modi government in 2014 to 15, tax transfer was 3.38 trillion rupees and net transfer was 6.75 trillion rupees. This was a gap of 3.37 trillion rupees. A widening gap suggests an increase in discretionary transfers by the center. By definition, discretionary transfers may not be as transparent and can even lead to allegations of favoritism. Since taxation opportunities for state governments in India are limited, will it be a good idea if they levied their own income tax? Such a change will require a constitutional amendment that requires 2/3 majority in both the houses. It will then have to be ratified by more than 50% of all the state legislatures.
Well, that is problematic. I mean, there is a reason why the Constitution reserves the income tax for the center. And that is that income can be generated in one location and the person can be physically located in a different location altogether. For instance, the income that a person makes on, let's say, the share market, the income is being generated in, let's say, Mumbai, but the person may be staying anywhere in the country. So who levies the tax? Where is the jurisdiction? Given that our constitution mandates that people can move wherever they want in the country and that people can earn from whatever sources they like, having a state-level income tax is problematic.
While state-level income tax may not be a good idea, states can improve their fiscal condition by improving expenditure practice. The creation of capital assets has a long-term positive impact, and leaving room for it may decrease debt growth.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.